You know the dream, right? Living off a steady stream of dividend income. It's a super popular idea. But does it really tell the whole story anymore? Today, we're going to dig into that and see if there's a smarter way to think about how companies actually reward their investors.
I mean, come on, who doesn't love this mental image? It's the ultimate financial fantasy. You just own some stocks and boom, money shows up in your account. This stream of truly passive income is exactly why dividend investing is so huge. It feels simple, it feels real, and it feels safe.
Okay, so let's just make sure we're all on the same page real quick. A dividend, it's simply a company sharing its profits with you, the shareholder. You own a tiny piece of the business, and when that business makes money, you get your cut. For decades, this was pretty much the way companies rewarded their owners.
But this is a really big but. The way corporations play the game has changed. That simple story of dividends that we all know and love, well, it now has a major plot twist.
And that brings us to the real question we've got to ask. For a long time, dividends were the main event. But starting back in the 90s, something fundamental started to shift under the surface of corporate finance. The story got a lot more complicated.
So what happened? Well, there was this massive structural shift. Before the 1990s, if a company had extra cash and wanted to give it back to you, the shareholder, they almost always did it with a dividend. But then, a totally different method started to get incredibly popular: stock buybacks. The reason? They were just more flexible and often way more tax efficient. This wasn't just some minor adjustment, it was a fundamental change in how companies behave.
All right, let's break that down. The old way was simple, a cash payment sent right to you. The new way is different. The company uses its cash to go out into the open market and buy its own stock. Now, this reduces the total number of shares out there. So think of the company as a pie. If the company buys back and gets rid of a few slices, your slice of that pie automatically gets bigger. Each share you own is now worth more. Both methods return cash, just in completely different ways.
So, if just looking at dividends gives us half the story, how do we see the full picture? Well, this is where a much more powerful idea comes into play. It's called shareholder yield.
Building this concept is actually pretty easy. The first piece of our puzzle is the one we've been talking about this whole time, the good old-fashioned cash dividend. That's still a super important part of how companies reward you.
And now, we add that second, newer piece to our puzzle: net stock buybacks. This takes into account all the value that a company returns to you by buying up its own stock. So now we're combining both of the major ways a company puts cash back into the pockets of its shareholders.
And here it is, the complete formula. When you add the dividend yield and the net buyback yield together, you get shareholder yield. And this isn't just semantics, it's a completely different lens for looking at a company. It's a much more holistic and honestly more accurate measure of the total cash a company is returning to you, its owner.
Okay, this all sounds great on paper, but does it actually work in the real world? Well, lucky for us, this exact strategy was put to the test over an entire decade. And let me tell you, the results are pretty jaw-dropping.
So an ETF based on this whole shareholder yield strategy, its ticker is SYLD, was launched way back in 2013. And its performance was then compared against a massive group of its peers. We're talking 188 different funds, all focused on dividends and buybacks, over a 10-year stretch. So this was no small-scale test, right?
And the result? I mean, this is the punchline. How did this strategy stack up against all those other funds? It outperformed every single one of them. Not some of them, not most of them, all of them.
Let's look at the hard data, because the numbers don't lie. From its start in May 2013 all the way through the end of 2023, the shareholder yield ETF returned an annualized 12.91%. As you can see, that not only put it at the absolute top of its peer group, but it also edged out the S&P 500's total return over that same time. The proof is right there in the performance.
So, let's get to the most important part. What does all of this actually mean for you? How can you use this to change the way you think about investing?
Okay, let's just boil this all down. First, that pina colada on the beach dream isn't wrong, it's just incomplete if you're only focused on dividends. Second, you have to recognize that stock buybacks are a massive, totally legitimate way that companies return value. Third, using a metric like shareholder yield gives you a much clearer, more complete view of a company's total payout. And finally, as the data pretty clearly shows, taking this bigger picture approach can make a real difference in your results.
And that leaves us with one last question for you to think about. The next time you're looking at a company or a fund, just ask yourself this. Are you only seeing the dividend, or are you actually seeing the full picture of how that company is rewarding you, its shareholder? It's a simple